Hello, everyone. I'm Jefferson Lilly with Park Avenue Partners. What I'd like to do here is take you through this presentation for our new fund. We'll cover a bit about my background. We'll cover our investment thesis, case study, our track record, and just give you an overview of what we're doing. We'd very much love to co-own mobile home parks with you. We think, again, this presentation will answer most of your questions, but if not, feel free to reach out to us. There'll be contact information at the end of the presentation, and we'll be happy to answer additional questions. As always, please read our private placement memorandum, do all your diligence, get all your questions answered before considering investing. And again, it's just the PPM that makes the official solicitation for the securities. So again, let's chat first about my background. I've been in this business about 14 years. I got started back in 2007, buying a couple parks for myself outside Oklahoma City. Since then, I've gone on to raise three previous funds. Cumulatively, we've raised about $36 million with the previous funds. With that, we bought about 33 mobile home parks in 15 states, almost 4,000 pads. Across all those funds, I've had a bit over 200 investors. Thankfully, and so far, nobody's ever suffered a loss. Can't make any guarantees about the future, but we're pretty confident in what we do. I've got a fancy MBA from Wharton. Never would have thought I'd be in the mobile home park business coming out of business school 20-something years ago. But I think once we get through this presentation, you'll understand why I'm excited about this niche. I think I'm the only Jefferson Lilly up on LinkedIn. Please connect with me there. You'll see more about my background previous to mobile home parks up there on LinkedIn, and please connect. So other than when I'm doing mobile home parks, the only other thing I do really is spend time with my family. This is the extended team, as I call it. My lovely wife, Katie, and my kids, Alistair, Gordon, and Caroline. I'll tell you a funny story about Alistair. This is now going back at least 2 years ago. So he was at the time more like 4.5 or 5. He came into my office and began air typing on one of my tables. And I asked him what he was doing. You know, he was pretending to type at a computer. He said, "I'm raising a fund." That was quite a surprise to me. I had never really discussed with any of my kids what it is that Daddy does. So I began to probe, and I said, "Okay. What are you gonna buy?" And he said, "I'm buying mobile homes." I said, "What are you gonna call your fund?" He says, "Alistair's Fund." And I then said, "Okay, how are you gonna raise money?" He said, "Oh, Daddy, all of my friends, mommy and daddies, know I'm doing this. They're all giving me $100. So anyway, there is Alistair's Fund as well for your consideration. Anyway, just tell you a little bit about our family. So for those of you that may not be at all familiar with mobile home parks and think this is something icky or weird to invest in, let me go through our investment thesis. This will lay out why we like this niche so much. So from our vantage point, there are really 7 industry dynamics that make this a compelling niche. 4 of those are very high level. We call them macroeconomic. 3 of them are right down at the property level. We call those microeconomic. Not surprisingly, when you've got 7 things going for you, you've got an investment that's probably pretty low risk and recession resistant. So at the high level, the macroeconomic level, mobile home parks are still a relatively mispriced asset class. they're certainly becoming more popular. Cap rates are compressing, prices are going up, but there's still not quite the feeding frenzy for these that there are for traditional multifamily. That would be apartment buildings. Many would-be buyers and investors, again, have a very negative perception of mobile home parks. Somehow they're all icky and full of bad people and drugs and guns and whatnot. That may be true for the bottom 1 or 2% of mobile home parks. It's also true for the bottom 1 or 2% of apartment buildings or site-built houses as well. But anyway, for some reason, this niche of mobile home parks really gets a disproportionately negative perception, which really isn't correct. The overwhelming majority of folks in mobile home parks are good, hardworking, law-abiding citizens that just really are working to better themselves and have a better life. And again, get out of apartment buildings and actually own their own home. Anyway, that negative perception, though, still means there aren't as many buyers going after this niche as there might otherwise be. It's also mispriced because many of the sellers are mom and pops. They've never been through a sale before. They haven't bumped rents up. Maybe they haven't even invested in rehabbing mobile homes and really putting some sweat equity and some money into their communities. Because of those reasons, many sellers don't maximize the price. They've again let their communities fall into disrepair, and again that creates an ability for us certainly to still pay a fair price, but then we do that sweat equity and we put in some money and again are able to improve them. So again, it's a mispriced asset class. Our thought actually is in the long run, which still may be not for another 10 years, but our thoughts are that mobile home parks, because of these favorable dynamics, that mobile home parks will trade at lower cap rates than apartment buildings, than traditional multifamily. Time will tell. None of our numbers are actually based on that kind of financial leverage, but if it happens, and we think it will, it's going to make now a very good time to be investing. Secondly, this is really a government-enforced oligopoly, not a monopoly generally, but an oligopoly. You do have competition, but because pretty much every city and county has outlawed new mobile home park construction, again, there simply aren't new mobile home parks being constructed. So investing in this niche really means you'll never have any more competitors. Politicians on both sides of the aisle tend to talk out of both sides of their mouth. They say, sure, we love affordable housing, but not in my backyard. So again, it's really extremely difficult to construct these. So this niche, again, you're in an oligopoly position. And again, unlike virtually every other niche of real estate, which does tend to have overbuilding, that's really historically been the kiss of death for real estate investing. As you make some money, things go well, and then you have 10 new apartment buildings or shopping malls or senior living centers or whatever, all going up in your town. All of a sudden there's overbuilding. That doesn't really happen in this niche, where it's just almost impossible to build additional properties. Third thing that this niche has going for it is shrinking supply. As I've just referenced, that supply curve is really fixed. It's just not possible to build new mobile home parks. Actually, that supply curve is shrinking in. We believe about 1% of mobile home parks get plowed under every year and redeveloped into some higher and better use. I've seen them redeveloped into Walmarts, self-storage, student housing, and some industrial uses. So again, about 1% of mobile home parks get redeveloped every year. So that means the supply curve is shrinking about 1% a year. As those 1% of those mobile homes get displaced, those homeowners have to go somewhere. So the fact that the supply curve is shrinking 1% a year, that really creates 1% demand every year. Then the fourth thing is that regular demand for housing grows about 1% a year. That's true, again, for site-built housing, apartments, mobile home parks. Our population tends to grow about 1% a year. So with 1%, I'll call it natural growth, and another 1% displacement growth, we have demand of about 2% a year growth for mobile home parks. The supply is again shrinking about 1%. So there's about a 3% supply-demand imbalance for this niche. That's again something that very few other real estate niches benefit from. Down at the property level, the macroeconomic level, there are three things that again make this further an interesting niche. First, the tenants are fairly stable. It costs around $5,000 to move a mobile home. Again, these are not RVs. These are tied down, indeed with skirting and on piers, but they're connected with really permanent utility connections, the water, electric, gas, if any. Again, it runs about $5,000. That would be for an in-town, say less than 100-mile move for a single wide. Tenants generally can't afford that. If a tenant has to move cross town or to a different state, they don't take their homes with them. They'll sell them in place, generally on their own. They'll put an ad up on Craigslist, Facebook, etc. They'll get that home sold to a new tenant, and then we run that background check on those new tenants, but then those new tenants take over the ownership of that home and continue paying us rent. We estimate that, so really the tenant in our world of view is the mobile home. It's not so much the person in it. Now, we certainly think people stay 7 to 10 years in their homes. We think, though, that the mobile homes stay probably for at least 20 years on average. So that means our turnover is more like 5% per year, perhaps less. That compares quite favorably with traditional apartment building investing, where tenants tend to turn over, excuse me, about every 2 years. So you have about 50% turnover of your tenants in traditional multifamily. Again, it's 5% or less in mobile home parks. Secondly, the maintenance costs are pretty low. We certainly do have to maintain the land. So that would be pothole repairs, certainly plumbing is probably the biggest expense. Some mowing, tree trimming. We do have some repair and maintenance expenses. But again, most of the mobile homes in our communities we don't own. So all those proverbial leaky toilets and leaky roofs are on the tenants to maintain themselves. But frankly, it's much less expensive for a tenant to maintain their house. Repairing, say, a proverbial leaky toilet for a tenant means they spend $12 or so on a flapper down at Home Depot, and they fix that leaky toilet themselves. If we owned that house, that sort of a repair would probably be 10x, probably $120 to get a plumber on site to do the same work. So it's really a win-win for us as landlords and for the tenants that they own their houses. They're then, of course, not paying rent on the houses once they own them, and they're living for a lot less money than if they were in an apartment building. But anyway, our maintenance costs, repair and maintenance, tend to run somewhere around 5 or 6% of rents. Our understanding is that apartment properties run more in the range of 15 to 18% of rents going to repair and maintenance, about 3 times higher. And again, we think pretty much all that extra 2/3 of what would be our repair and maintenance budget goes to, again, maintaining the improvements to the land, those apartment buildings with their proverbial leaky toilets and leaky roofs. So we generally just have to maintain the land. So lower maintenance costs. Finally, I've had some investors say, hey, sounds like a great investment thesis, Jefferson, but too bad it's just raw land, and therefore you have no depreciation. And again, that perception is incorrect. Prior to the current tax law, the Trump tax law coming into effect, we were still depreciating about 75% over somewhere around 18 years. With the accelerated depreciation under the Trump tax law, we've been depreciating something around 64% of our purchase price in the current period, in the current year of acquisition. Indeed, these are not raw land. If they were raw land, there would be no roads for our tenants to drive up to their homes on. There would be no water, there would be no sewer, there'd be no fences, signage. Those are all the sorts of things that we're able to depreciate. So again, it's nearly 2/3 of our purchase price that we're now writing off in the current period. So we believe that'll get our investors to be able to write off around 100% of their investment. Again, these are losses purely for tax purposes, not real losses, but for tax purposes. The depreciation of mobile home parks is quite good. This is a low risk business. We know that because we've looked at the public markets. I don't want to get too business school geeky here, but a general measure of risk is what's called beta. It's really sort of how your stock varies relative to the market as a whole. And by definition, the market as a whole, call it the S&P 500, has a beta of 1. As you might imagine, certain high-tech stocks tend to be very volatile. They might have a beta of 2 or more. They might move twice as far up or down in any given day as the market as a whole. We've looked here at the 3 publicly traded mobile home park REITs. So a couple of things stand out. Their beta is about 0.55. It's roughly half. These stocks tend to be about half as volatile. So if the market is up 1%, they might only be up 0.5%. If the market is down 2%, they might only be down 1%. Frankly, these stocks also have a number of days when they might tick up, when the market as a whole might tick down. So all of that gives them a relatively low beta. So the market is telling us here that the risk of investing through these publicly traded companies, the risk is about half what it would otherwise be investing in the market as a whole. So indeed, low risk. A couple other things stand out from looking at the public companies. First, institutions, presumably that's the smart money. Institutions own about 95% of these stocks, and they have for a long time. Another thing that stands out is the price to book ratio. That is basically the premium that you pay above and beyond what the asset value is. So for instance, if you were to, you'd have to invest about $6 in these stocks to end up owning $1 worth of real estate. That's quite a premium. Indeed, these are publicly traded stocks. You can sell them and get liquid in 3 days. That's not the case with a fund like ours. But with a fund like ours, if you were to invest $6, we would actually go out and buy $6 worth of real estate. There's no premium for investing through a fund like ours, no public market liquidity. So our price to book is effectively 1. Then I'll also just comment here on the dividend yield. These publicly traded stocks have been yielding about 2% per year. Our most recent fund, which is not mature yet, is already yielding better than 5%. And some of those properties we've acquired just last December, about 7 months ago. So we think our returns to investors will improve well beyond 5% per year. But again, suffice it to say that because investors that invest with us aren't paying a premium to the real estate, we're already distributing to them more than twice the dividend rate that the public markets are yielding. Also, we again return that depreciation, which has very significant tax benefits. That's something you don't get by investing through the publicly traded markets. So suffice it to say, the public markets verify our investment thesis that mobile home parks are very low risk. We then looked specifically at the last major recession, the 2008-2009 housing recession. And just to be clear, of course, this was a housing recession. This was not like the dot-com collapse that was in tech, that was in, a different part of the economy. Back in 08 and 09, when the housing market collapsed, that recession was triggered by this industry, the housing industry. So how did the stocks do? How did the companies do throughout that recession? As you'll see here, we went back and we looked at the average of the what we call funds from operations, FFO. It's basically the amount of cash that these REITs earned. Again, they're REITs, they have to pay out something over 90% of their earnings. So this was actual cash that these REITs generated. So for the year prior to the recession, just to be clear, the recession was declared for 6 quarters. It was all of 2008 and the first 2 quarters of 2009. So for the year prior to the recession, these 3 publicly traded companies generated a little over $38 million per quarter in cash that they paid out to their investors. Then the recession hit, Q1 of 08, lasted for 6 quarters, and what happened? The earnings were higher. During the recession, the earnings grew to a little better than $42 million per quarter. In particular, the industry's best ever quarter to date was Q4 of 08. And at that point, the stocks had sold off about 45%. The stocks were trading at 55% of their value 1 year prior. So investors got very nervous. From 1 year prior, they sold off these stocks 45%. They pushed down the stock price right during the industry's best ever quarter. Then the industry had its next and even better best ever quarter in Q1 of 09, and the stocks didn't recover very much. That would have been the time to buy. Prices down 45%. And the industry has its 2 best ever back-to-back quarters of cash distribution, real earnings and distribution to investors. But investors that held on for the long term, then a year after the recession, their stocks would have been up on average about 6% versus what it had been in the year prior. Plus they would have collected that too. Back then it was closer to a 3% annual dividend. So investors that were long-term did quite well, collected dividends all the way through, made money. Investors that got nervous and sold off, of course, sold off at the wrong time. But this niche, I'll also then just highlight the year after the recession, earnings increased even more to about $48 million per quarter. So the recession slowed the earnings growth, but did not by any stretch of the imagination, cause bankruptcies or cause the industry to even shrink. Things continued quite well. So again, the industry did very well. Investors got nervous, but the industry did quite well. All right, let's look now at a more recent crisis, the COVID crisis. So we've looked here at, again, how the stocks have done prior to COVID. That would have been really all of calendar year 2019. And then how the stocks have done now that we're in COVID, hopefully coming out of it, we'll see. But for 2019, these stocks, and it's been 12, 13 years since the previous recession, these stocks are now distributing over $215 million per quarter. What we saw then, that's about a 5 times growth over the previous 12 or 13 years. So COVID comes in to effect really sort of late Q1 of 2020. And what happens then to earnings? Earnings are averaging about 242 million, again, up from 215 prior to COVID. The stocks have recovered. They were, again, we indexed them here to 100 for the year prior. They peaked up just prior to COVID. They sold down, still higher than they were a year prior, and now they're up about 39% from where they were in the year prior to COVID. So even the most current non-housing related recession or crisis, call it what you will, really has not dented the performance of these stocks. Mobile home parks are still doing just fine, even in the COVID crisis. Whoops. So again, to summarize here, not surprisingly, when you get all 7 things going your way, you've got a business that's likely to profit in both good times and in bad. So let's look at a case study of what is our worst deal. At this point, most money managers would show you their best deal. We're going to show you our worst deal. So this is a property called Tulsa Estates. It's in the Tulsa Metro. It's there on the southwest side of town. You'll see there from the photo on the left, it's a mix of homes. The home on the left with the White House with sort of the aqua colored shutters, that's a vinyl shingle house. It's wrapped in vinyl. It has a shingle roof, really very similar to a regular site-built house. The home on the right there that's white with the gray, a little bit obstructed by the sign, that's what we call a metal house. That's probably what you think of when you think mobile home parks. That's an older mobile home. That one probably goes back to the 1990s. Again, sort of a corrugated metal exterior, walls and the roof, all a metal. So this property, again, had a mix, frankly, more of the older metal homes. We acquired this property in late 2014. We like Tulsa. It's a diversified economy. We paid just a little over $1.1 million for this property. That was about a 10 cap. It's a 93 pad community. At the time, 61 of those pads were physically occupied with a mobile home. So we had about 1/3 vacant. And of those 61 homes, 26 were what we call park-owned homes, POHs. And 12 of those 26 homes seem to be in perpetual rehab. We'll talk a little more about that. The lot rents were about $180, which was a bit below market. And it had been 2 years since the mom and pop owners, really it was a pop and pop owners, 2 guys that had done some single family house deals together and then an apartment deal, and then did this one mobile home park deal together. But the pop and pop management team, again, hadn't bumped rents in 2 years. They were out of state. They also had not been on site in 8 years since they acquired this property. So it was really being undermanaged. And again, they weren't really in property. But fortunately, we're on city water, city sewer here. That's something that we like. Most of our properties, really so far, all but one, are all city water, city sewer. That, of course, just means that if you have any infrastructure problems, they're not your headache. You don't have to dig a well deeper or fix septic systems or whatnot. So we prefer all city utilities. It's not mandatory, but we prefer all city. And this was that. The property came with a good manager who was also the repairman. The previous owners, the Pop and Pop, were paying, I believe, an extra $1,000 a month for him to do all the repairs. Alas, he was not repairing the homes. There were 12 homes just sitting there still unrepaired. He just hadn't been managed well. So we stepped in, we restructured his pay, kept him on as the manager, and said, you know, we would happily pay him $1,000 or more to rehab homes. But of course, that was now going to be piecework by the job. He was going to have to actually rehab homes to get that additional repair and maintenance pay, which he did. He began actually rehabbing homes. We also brought in another crew to augment his work just to get some homes repaired more quickly. We removed a ton of junk. It was actually many tons. I think 4 of those 12 park-owned homes were beyond repair. Many of them had broken windows or doors, and kids were getting into them. Obviously, that's a health and safety concern. So those are the kind of things that we address when we acquire a property. Health and safety stuff gets taken care of first. You know, then we go about bringing in homes and rehabbing them and whatnot. But again, we scrapped out 4 homes. Each home probably weighs at least a couple tons apiece. There were also branches, tires, old decks, just all sorts of junk, as well as some spray painted graffiti that we cleaned up. So we invested some real money getting the park physically cleaned up. We then enforced no pay, no stay. The previous owners were working with tenants who said they couldn't afford to pay. Again, we enforce no pay, no stay. Tenants do have to pay rent to remain in our communities. Many started doing that, but we did lose a couple. We also had at least 1 sex offender in the park. So occupancy dropped a bit initially. We call that the J curve. Not named after Jefferson, but just occupancy will drop initially, and then on the backside, it gets higher. So we saw that after 2 or 3 quarters, occupancy was higher than before. As I mentioned, about 1% of mobile home parks close every year. We got lucky in that, I believe in our 2nd year of ownership, our closest competitor closed. So we bought 5 pretty good quality vinyl shingle mobile homes and brought those in. Kind of got a bulk discount on getting all 5 moved. One of those homes came with a tenant, not literally in it, bouncing down the road, but one tenant already had their home under a rent-to-own agreement. So of course we honored that. So we already had a tenant in that home. The other 4 we got occupied, I believe, in under 2 months. What we found though, as we finished the rehab job, was that especially some of those older metal homes, they kept bouncing back to us. I think what we missed with this property was its location. It's in an industrial park. To get to it, very difficult to find. And then you drive past a concrete factory. You drive past a chili factory where they're literally cutting up meat and vegetables and making chili. Then you drive past the oil field services pipe yard. And then you get into this community. So it's again hard to find. It feels fairly homey once you're in it, but it's not anything like driving through a regular neighborhood to get to it. So especially those lower quality homes kept boomeranging back to us. So after about 4 years, we kind of felt like we were running in place. We decided to sell it, and we figured we'd still do pretty well. We ended up selling this property to one of America's 10 largest mobile home park owners. They paid us $1.5 million for it, so we made almost $400,000 from that. Plus, again, we were earning money and paying out dividends to our investor most quarters. We did have, some reinvestment, but all in between the quarterly payments and the split of profits at the end, our investor got right about a 10% IRR. They made about 40% on their money spread out over 4 years. So that's better, frankly, than what the stock market had been doing. It's unfortunate that this property just didn't work out as well as we had hoped. But again, we still ended up making about a 10% compound IRR for our investor. So no guarantees about what the future holds, but this is a deal that didn't live up to expectations and still generated a pretty good return for our investor. What I'd like to cover now is my track record with my previous funds. So for those of you that have known me longer, you'll know I started my first fund with a partner back in 2015. That was under the Park Street branding. I'm now here on my own with the Park Avenue branding. I'm not a one-man band here. We'll talk about my team in a bit. But anyway, this first fund, the Park Street Partners Fund, formed back in 2015, we raised right about $5 million, and we bought 6 mobile home parks in 5 different states. As of today now, July of 2021, 4 of those 6 have been sold. We have 2 others, I believe both under contract, and we anticipate that they will sell by the end of this year. So this fund has returned already every bit of investors' money plus another 53%. So we've returned 153% of investors' capital. We anticipate with these 2 remaining properties selling, we think by the end of the year, that we will return something around an additional 31% to investors. So they'll all in be getting something around 180 some odd percent of their capital back. So assuming those transactions work out as we think they will, that means our investors will get not quite a 15% IRR. They'll be compounding their money for the last 6 years at about 15% a year. There's already a 10.9 IRR in the bank. So even if those 2 remaining properties sell for 0, which is highly unlikely, but even if not another dime comes back to our investors, they've already made nearly an 11% annual rate of return, being a limited partner in our first fund. So time will tell, but I'm pretty confident we'll again be getting our investors about a 15% rate of return. We then raised a second fund that was late 2016 and into 2017, raised here a bit over 14 million, much larger fund. We acquired 12 properties in 9 different states. As of today, 8 of those have been sold and 4 remain. We've returned so far 135% of investors' capital. So investors have gotten all their money back plus 35% more. We anticipate they will get roughly another 11% of their capital back. So these investors have already a little better than a 9% IRR in the bank, money that's already been returned to them. We anticipate they'll probably be a little better than an 11% IRR once we get these additional 4 properties sold. Time will tell. Then my previous Park Avenue fund, it's really my 3rd fund, but it's Park Avenue Partners Fund 1, was formed in 2019. We raised even more money, $15.8 million. We've acquired 13 properties, all of them off market. No guarantees about what the future holds, but we obviously prefer off-market properties and have made a much bigger effort to source off-market mobile home parks. We've done that in 7 different states. Some of these acquisitions have been as recent as just last December, about 7 months ago. So again, it's still a very young portfolio. We have not even gotten water meters installed at all the properties. We're still bumping rents and certainly have lots of infill remaining. But already at acquisition, these properties appraised for a little better than 44% more than we paid for them. For those of you that have bought deals, you know it's generally hard to get an appraiser to appraise anything at more than what you pay for it. So we think we've done well and bought these right. And on paper, again, already the fund would be up a little better than 44%. Frankly, I think those appraisals still are low, but I'm biased. You can make up your own mind. Again, we're returning so far a little better than 5% annually to investors in our A shares. That's improving. Again, we think that'll continue to improve for several years to come. If we were to sell everything today, we would have again paid out some quarterlies. We would be splitting that profits with investors. And we're not sellers, but if we were, we believe our investors would get about an 11% IRR from investing in this fund. Again, still rather, the properties are still fairly new. We think we'll do better, but that's where we'd be today if we were to sell. So again, a double-digit return for investors. So we bought properties nationwide. We'll go north to south. We bought a little better than 200 space park up in Fairbanks, Alaska. That's Fairbanks's largest and nicest park. There's a claim to fame. We've bought 2 properties all the way down in the very southern tip, the fingertip of Texas, down in Brownsville. We bought a property in El Paso, one in Roswell, New Mexico, one up in Pocatello. We've got one in Hastings, Nebraska, 5 in the Sioux City, Iowa metro, and one that's about 25 minutes outside Omaha, Nebraska, over in Iowa. This fund is now probably pretty fully invested. It's a chance we'd make a small acquisition or perhaps just invest in some additional mobile homes. But as you can see here, again, our investors are making a concentrated investment in mobile home parks, but we tend to buy wherever we find well-priced deals in healthy economies with upside, right? Through rents, maybe billing for water, and bringing in homes to infill the communities. So we don't have a geographic focus, for better or for worse. We'll buy really anywhere that we get a good deal. But that means our investors get geographic diversification. Heaven forbid if something goes wrong with the economy in Pocatello, Idaho, that's not likely to impact Fairbanks, Alaska, or Brownsville, Texas. So again, investors get geographic diversification with us. We really just do mobile home parks and some RV, but again, they're getting a fair amount of diversification across economies with us. So Fund 1 here invested in a range of parks, some with amenities. Our Breeze Lake community, that's down one of the 2 down in Brownsville, Texas, comes with a pool, a nice office, shuffleboard. It's really about half mobile home and half RV, and it's just a gorgeous property. The other property that we bought there, Sunset Palms, also very nice pool, jacuzzi, shuffleboard, etc. Not all the properties are that nice. As you can see from the home in the bottom center, that's, I believe, from our Fairbanks, Alaska property, Lakeview Terrace. It's just things are rougher up in Alaska. Everything, site-built houses, mobile homes, apartments. The winters are long and rough on structures. But again, I think we got a very good deal on that. You don't have to have gorgeous homes and pools to make money. You may actually make more money on some of the rougher parks where you can do some real value add and improve them. So who's to say exactly what fund two will buy, but it will probably be a similar mix of some better quality and some more modest quality mobile homes and mobile home parks. And again, we may acquire some RV parks, especially if there are RV parks where we can bring in mobile homes and migrate them towards a more stable, more permanent cash flow. So let's talk now about Park Avenue Partners Fund 2. We've just opened up the fund. We have already better than $1 million invested with us in just the last week. So thank you for those of you that have already jumped in. This fund really will be what I call same song, second verse, or maybe it's same song, fourth verse, depending on how you count. What we're doing is what we've done with our funds all the way along. We keep operations in-house. We think this is a quirky niche, and frankly, I've tried both a very large outside management company, a medium-sized management company, and a very small outside management company, and none of them worked out well. So you can decide what you think that means of my judgment to have done this over the last 7-8 years 3 times, but we're just not doing that anymore. We keep the property operations in-house. We also will be, we think, continuing to be able to source deals off market. It's not to say we wouldn't buy from brokers. I suspect we will, but in general, we're able to get better pricing and frankly close transactions more quickly when we're talking directly with a seller. Again, rather than going through a broker, but again, I suspect we will buy some, at least from brokers. And as I mentioned earlier, we may acquire in this fund some RV parks, especially if there's the ability to migrate them to be more permanent tenants, obviously bringing in mobile homes. We continue to do financial reporting and make distributions quarterly. We've always gotten the distributions out within the month after quarter close, so within 30 days of the quarter close. And then we do, again, quarterly webinars with our investors. We review complete financials with them, both at the property level and also up at the fund level. And investors are welcome to ask questions live and or to just email me, call or text with questions pretty much anytime. But again, we do have those structured quarterly webinars live with pretty much all the information anybody would ever want. I mentioned this earlier, it's not just me here at Park Avenue Partners. We have a team now of about 11 people. That goes me, asset managers, and down to property managers. But we do have key man insurance. Sorry, we will be getting key man insurance in place. In particular, that will pay about a 10% return, but a 10% one-time gain to investors if, heaven forbid, something happens to me. I don't want to make that payout too good, but it would pay investors, again, about a one-time 10% profit. We then, above and beyond just having insurance, we actually have a succession plan in place with an individual who's an experienced mobile home park owner-operator He's actually been in the business longer than I have and just manages some parks for himself. But again, heaven forbid if something happens to me, you all would get about a one-time 10% payout. I believe it's actually tax-free because it comes from life insurance. And then again, we bring in the new person and put the properties through an orderly liquidation. That process would probably take 2 to 4 quarters. Certainly no guarantees, but I'm fairly confident it would get everybody their money back. The quarterly earnings would continue during that liquidation period. Again, life insurance premiums would be paid out, and likely everybody would get their money back over probably not more than a year. So again, I'm not exactly a one-man band over here. There are about 11 of us right now, and we're growing. That may well double over the next couple of years with this new fund. But we've got the key man insurance in place, and again, we've got a succession plan in place. And then as regards our financing, that'll continue largely as it has. We're looking to acquire really sort of all ages, bread and butter, basic mobile home parks, generally throughout the Midwest. Again, we'll acquire opportunistically. Maybe we'll find something else in Alaska. Who knows? But I think more likely we'll be investing probably principally in the Midwest. This fund can go up to 25 million. We'll just see where we're at. I don't think we'll continue raising money at the rate of $1 million a week, but we may get up to 25 million. We'll just see. The fund will be open likely for a full year, so that would be until July of 2022. Again, unless somehow we max out and fill up in advance. And then we're looking to get, I think, prudent amounts of leverage on the properties. That's been somewhere between 65 and 70%. Frankly, very few lenders would go anywhere near 80%. And as I'm signing personally for some of this debt, I just probably, again, won't want to go too high. I probably won't want to get leverage too high. So I anticipate, again, will be something 70% or a little under loan to value. And we'll see where we borrow. I've borrowed from banks. I've borrowed from the CMBS market. The collateralized mortgage-backed securities market tends right now to be pricing pretty well. But we're open to financing seller carry. I've done some of that, and we're open to financing from Fannie or Freddie, the agencies as they're known. So again, I think we'll have prudent leverage, and we're really pursuing a tried and true operating plan. I want to highlight something that makes us pretty different from most other real estate funds, and that is simply that I take no fees. I take no salary. I don't even put my cell phone bill through Park Avenue Partners. I just get that split of fees, and in my worldview, that's perfect alignment. You decide what you would call alignment, but in my world, where again we're all making money the same way and splitting fees, that's my view of perfect alignment. That's what I'm excited about. And you'll see this written right here. I've just copied the section out from our private placement memorandum that I'm simply not getting paid fees or commissions, not for acquiring the properties, not for arranging and even personally guaranteeing the debt. Let me also call out, I don't backdoor profits from our management company. Some funds will do a $5,000 rehab on a mobile home and charge their fund $20,000 for that. I don't operate that way. I operate our mobile home I operate our management company as a not-for-profit. So if we do a $5,000 rehab, it gets billed at $5,000. There's no markup. So again, I take no backdoor profits from a management company, no salary, no fees of any kind. The little winking emoticon there. That was my idea, my edit into the PPM. The rest of it was the attorneys. So I want to highlight the impact of fees. I've had some investors say, you know, that's nice, Jefferson, that you don't take fees, but you know, it's only a 2% acquisition fee. It's not really that much what these other funds do. So just to call out some of these funds, some of these fees, a 2% acquisition fee is 2% on the full value of the property. So with leverage, say if an investor invests 100 grand, another sponsor might go out, lever it up, borrow 300 grand and buy 400,000 worth of real estate. And of course, 2% on the 400,000 is $8,000. That's 8% of investor capital that goes in many funds that goes to an acquisition fee. Similarly, charging 1.5%, which many other funds do on the debt on that 300,000, that would be $4,500. So that's another 4.5% of investors' capital to fees. Other funds, again, will charge at least a couple percent in management fees. Frankly, a lot of other funds that do pay a preferred return, at least early on, they're not actually earning that much money. So they may take, you know, if it's early on in the fund, they haven't done a deal yet, they owe, say, 2% for that quarter, they may just have to take $2,000 off the balance sheet and pay it out to investors. And again, who knows how many quarters that may go on for, or at least making partial payments, partially out of earnings and partially out of capital. But again, we don't pay a preferred return, not on our A shares. And when we do pay, we've got we'll talk more about this, we do pay a preferred return on our B shares, but that comes from actual earnings. We don't pay out simply because, you know, we quote unquote have to. All of the earnings that we pay out come from actual earnings. So what that means, again, more of your capital will actually go to work in our fund buying real estate. I've talked a little bit about management companies. That can be an ongoing way for other general partners to backdoor profits every year. So when you add up all the fees, frankly, $100,000 invested in other funds might only end up acquiring $75,000 to $80,000 worth of real estate. And also then those other funds are quite incented to buy really just any deal and even pay more for it, simply because the more they pay, the higher their 2% acquisition fees are. So in my worldview, that is not aligned. That's not aligning a general partner with a limited partner. So again, I take no acquisition fees. I'm not motivated to just go and do any deal just to pay myself fees. And then again, because I take none of these fees, that means dramatically more of investor money will actually go into real estate with Park Avenue versus the way other funds operate that charge significant fees. So again, alignment of interests is very important to me. All right. So what we're offering is both Class A and Class B shares. The Class A shares are just a straight up 50-50 split of all profits and depreciation. The fund will, we think, go for about 10 years, and we think will generate about a 14% IRR. Again, no guarantees, but that's our best guess at this point. The Class B shares do pay a preferred return of 6%. That's again when we have earnings. We'll pay out the first 6% to investors. If we're unable to pay it out, it does accrue. Investors don't lose that payment. It just simply accrues until we have higher earnings. Above that 6%, investors in our B shares will then get about 10% of additional profits. 90% of additional profits over that 6% hurdle come to me, to the general partner. We estimate the B shares will generate about an 8% IRR. We estimate it'll be more upfront in the first several years of the fund because of that preferred return, but then over the longer term, probably won't generate as much money. So if you're, someone looking for more current period income, the B shares might be right for you. If you're someone that's willing to earn a little less upfront and is a longer term investor, the A shares might be right for you. You decide, and I'm here to answer additional questions. There's also further detail on this in Exhibit 4 of our private placement memorandum. There's a financial model there and some additional color on the A and B shares. The minimum is $100,000. Nobody ever seems to ask what the maximum is, but there is no maximum. Or I guess we have about 24 million left in room in the fund. Again, I take no fees. Our interests are 100% aligned. The fund will likely go for 10 years. There is an option for both early liquidity and perhaps later, longer term liquidity. By earlier liquidity, I mean that I understand that life happens and some investors may need to sell their shares in less than 10 years. I think investors will do better holding for the long term and waiting for the properties to actually be sold. But we have had now, I believe, 2 investors out of our roughly 200 that have wanted to get out early. So I just put together a bit of an auction. I've got a mailing list now of over well over 5,000 people. So I'd be happy to do again what I did a couple years ago when investors wanted out. I simply put out an email and I try and get interest and get some bids, and then I simply introduce those wanting to sell to those people wanting to buy. Again, I'm not a broker dealer. I won't buy the shares, but I will help you find somebody who will. You're also free to find your own other party to purchase your shares. As long as they're also an accredited investor, you can sell your shares really at any time. I guess after the 1-year mark, you can sell your shares at any time to anyone else that you might want. So that's what happens if you need liquidity sooner than the 10-year mark. Then there's the option for longer term liquidity. So the question is, hey, if we raise money from 100 people, as we did roughly with the last fund, and 1 guy or 10 guys want to get out at the 10-year mark, but 90% of the people want to continue, what do we do? So there is the option at the 10-year mark, if I want to continue being your general partner, there is the option for some of us to buy out other parties that want to get out. And at that point, we would hire 2 different appraisers to value all of the properties. We average those 2 appraisals, and that establishes the price at which we buy out investors at about the 10-year mark. We won't charge those investors transaction fees, which frankly, just brokerage fees alone could be upwards of 6% of sale price. So again, we'll charge no fees to those that want liquidity. For those of us that are continuing the fund, and this again assumes if I want to continue being your general partner in 10 years, which I think I would, but I can't make any guarantees now about what my life is going to be like in 10 years. But again, if this works, then we can buy out those folks. The advantage for those of us that would continue with the fund is that we continue to own properties that we know and love. We are not buying them out of the fund and into a new fund. We're simply recapitalizing this fund and providing very fair pricing and liquidity to some LPs. So the implication there is that presumably these properties won't be assessed upwards for property taxes. They'll continue to be owned by the fund. We simply recap the fund. So that's the option for longer liquidity. I think really the most conservative way to think of this, and the way I want limited partners coming into the fund, is to think that it's a 10-year commitment that you hopefully won't call me in a year or 5 years and say, hey, you want to sell and get out early. Think of this as a 10-year commitment. And then think of us, frankly, as not continuing the fund, and we simply sell at the 10-year mark and split up profits. That's, I think, the most conservative, probably the most realistic as well assumption for the fund. And so that's what I want investors comfortable with, is again, presuming it's a 10-year fund, not longer, not shorter, but we do have some flexibility there. I'd like to talk a little bit about 1031s. This is something that we're going to accommodate with this fund. The way this will work, as we understand it, we've not done this in the previous fund, but the way that we understand that we can make this work is that if you have a property for sale, you would sell it and 1031 into one of the mobile home parks that we'd be buying. We, the fund, and you would acquire that property as a tenant in common, also known as a TIC. And then pretty much same day or next day, we do a 721 exchange. That's what would convert your interests in the property to be interests in our fund. Collectively doing a 1031 followed by a 721 exchange, this is what's often called a swap and drop. So you'll need to get your own legal advice and accounting advice as to whether this is something you should undertake. We are not advising doing this. We're simply, because we're not advisors, we're simply saying we know a lot of people have done this. We're happy to accommodate this if you determine on your own that it's something you want to do. Just to be clear, I don't believe this is the tax implications of this have ever been tried in court, and nobody really knows what the law says until something's tried in court. I also believe an awful lot of investors do this. But again, we're not specifically advising a swap and drop into our fund, but we are happy to accommodate it if it's something you want to do. I'll call out that, of course, I believe it's a 45-day window has to be observed between selling a property and identifying what you would then acquire. Frankly, lining up the timing between selling your property and us finding and closing on a property, that timing may not work out. So I just want to highlight, not as an advisor, but simply highlight that there is something called a deferred sales trust, also known as a DST. My layman's understanding, I'm not a professional with this, but my layman's understanding is that if you sell your property into a deferred sales trust, you then have virtually an infinite amount of time to then take your property out of that trust and complete your 1031. Again, because it's difficult to predict the timing of what properties we're going to close, I think I would suggest strongly that you look into doing a deferred sales trust rather than trying to line up that 45-day window between when you might sell something and we might have something under contract. But again, you pursue your property sales as you see fit. We're happy to be in regular communication and see what may be the best way to affect this. Just a couple other points here. So again, you should have your own exchange advisor. You'll actually sign on that closing statement with us. Again, as the initial 1031, will then 721 exchange your interests into the fund. My understanding is that with at least current tax law, there'll be no way to do another 1031 out of our fund. So this is sort of a final stop. You get to not pay taxes or defer your taxes one last time coming into our fund. But when we sell off the properties, again, presumably at the end of year 10, that's when your taxes would need to get paid. There just isn't any way to go from then the fund into some subsequent property. So again, get your own advice, legal and accounting on this. And if you determine it's something you want to do, terrific, we're happy to accommodate you. In closing, I just want to talk a little bit about some of these words that are on our website and in our PPM. Heritage values, inspired operations, and affordable housing multiplied. Sorry, that doesn't roll off the tongue quite as easily as Nike's "just do it," but I'll try and get better at our marketing lingo. But I actually did give a fair amount of thought to these words. Let me tell you what they mean for me and for our corporate culture. Heritage values really is all about the alignment that I've discussed, no fees, split of profits, we're together in this. And then also the transparency. Again, we do quarterly reporting and you get complete financials and the ability to ask questions live. That's what's important to us. There are, I think, very few other real estate or other investment partnerships out there that charge no fees and provide that level and that frequency of reporting to their investors. But that's what we do here at Park Avenue. Inspired operations, that again is really about keeping the operating team in-house. We believe that's the best way to achieve results. And results for us, of course, are financial, but also we also have a social mission, and that's expanding the supply of affordable housing. So again, while we are first and foremost a for-profit real estate partnership, we do have a social mission that's very important to us. Our typical tenant probably has household income of around $35,000 a year. And they may well be stuck in an apartment. When we can give somebody a clear shot at home ownership, often our tenants are, again, moving, new tenants are moving out of an apartment where they might have been paying $1,000, and we can get them into a larger, newer mobile home for $800 a month, maybe $900. That's a value to them. And then again, when they own that house, which could be the longest mortgages I think that we've structured are 15 years. We do sell more modest mobile homes for 2 and 5 year notes. But once folks own their own house, then they're just paying the lot rent, which currently averages somewhere around $350 across our portfolio. That provides real value to families to get them out of the game of paying rent forever and get them to actually be a homeowner. So we believe, again, keeping operations in-house is the best way to get homes bought, rehabbed, and sold to our tenants. So that is our view of how to multiply affordable housing. Whoops. Just some food for thought. I had the honor of meeting Sam Zell a couple of years ago, and he reiterated these words to me. I believe these are from his book, Am I Being Too Subtle, which I've also read and done a review of on our podcast. Sam thinks this is the greatest business since sliced bread. 4 or 5 years ago, Sam, and for those of you that don't know, Sam is chairman of Equity Lifestyle Properties. It's one of those 3 publicly traded REITs that we reviewed the performance of earlier. He's a self-made billionaire in real estate. So Sam is currently the largest owner of mobile home parks in America through his publicly traded REIT. Sam used to be the largest owner also of apartment buildings and office buildings. Over the last several years, he's sold off, I believe, most of his office and apartment holdings. To the best of our knowledge, he's never sold a mobile home park. So think about what that means. For those of you that are ready to move forward, I'll just highlight there is an Invest Now button. It's in the upper right-hand corner of our website at parkavenuepartners.com. Click there. I believe you then click Reserve, and you'll input your information. You can invest as a natural person, a self-directed IRA, a trust, an LLC. Really, any entity can invest with us. For those of you that have questions, I'm certainly happy to answer those questions. You see our phone number there, or email us simply at investor.relations@parkavenuepartners.com. For those of you that might want to hop on my calendar just to make sure I can pick up my call, there's my calendar link. So again, we'd love to co-own mobile home parks with you. We're happy to answer questions, whatever you may still have. We'll have some additional announcements as well about some other online live Q&A. And then also, I'll be traveling to roughly the 20 largest metro areas in America, hosting dinners and getting a chance to meet both existing LPs and new LPs. So anyway, between those dinners, assuming COVID allows, but between those dinners, and again, you just reaching out with your questions, I hope we get a chance to meet one another. I'm happy to answer your questions. And again, if you're ready to move forward, we'd love to have you click that Invest Now button and co-own mobile home parks with us. Thank you, everybody. Have a great day.